Kate, do you have another speaker for me?
Yeah, I believe we've got Tom Sosnoff hopping on here in a little bit. I think I just saw him hop in the room.
Hey, Tom, can you hear me?
Hey, John.
Hey, how's it going? I hear it's really hot out there in Chicago.
It is hot as hell.
Yeah, over 100 in the Windy City doesn't work for me.
I hear you, brother.
Okay, you get your PowerPoint up there and get your staff online. Tom Sosnoff is a recognized online brokerage innovator and sought after financial educator. He is a true visionary and serial entrepreneur who co-founded thinkorswim in 1999, tastytrade in 2011, and newly launched tastyworks in 2017. Leveraging over 20 years of experience as a market maker for the Chicago Board of Options Exchange and one of the original OEX traders in the S&P 100 index pit, Tom pursued a vision to educate retail investors in options trading and to build a superior software platform and a brokerage firm that specializes in options. His efforts ultimately changed the way these instruments traded by pioneering everything from single-click complex trading functionality, which, by the way, I love, to multi-product access from a single platform. Currently, Tom is the co-host of tastytrade Live and continues to drive innovation and know-how to the do-it-yourself investor, of which we have many. So, Tom, are you good to go? I see you have your people up there. So you have until 5 minutes before the hour, and then we give away our next batch of prizes. I'm going to go ahead and mute myself.
Thanks. Perfect. Hold on one sec. Just getting set up. I had to move John to a different room, so that's what just took me a second. But I should be all set up. Let me.
You look like you lost weight.
No. I am sitting. I'm sitting at a. I did lose weight from a couple of years ago, but I'm sitting at a. I'm at a good weight right now. I'm healthy.
So, well, that's the important part.
Yeah, thank you. I'm just sitting in a weird conference room. I'm not usually in this room, but it's good. Welcome everybody, and thanks so much for having me. I'm just give me one more second to get completely set up here because I had to switch gears. It looks like we've got Brittany and a whole slew of tasty people on here. Christian's on here, Brittany's on here, Kate's on here. So we'll see. Josh is on here. So good. We've got our whole gang. Hail, the gang's all here. Thanks everybody for coming on today. It's kind of a, and John, thanks as always for having me. And you know, I love doing these things. Let me close this up, move things to the side. I'm just getting my screen set up. It's a little bit of a weird setup, but I love having an opportunity to talk to people, a lot of people obviously that we sometimes never get a chance to talk to, and other times, you know, people that have heard, you know, multiple discussions over the years. I'm a junkie. You can never get too much of this stuff, and it's for me, it's just, you know, great to be able to keep doing whatever it is we're doing and trading in these kind of crazy markets today, being nothing short of a pretty big surprise, I think, after yesterday's huge rally after the Fed announcement, or decent sized rally. We've given it all up and some, and actually making new lows on the year right now with the S&Ps. You can see where my cursor is right here. S&Ps are down 120, which is a huge down move. The NASDAQ's down 450 points, which is right below that. These are the futures, and the Dow's down 725, and the Russell's down a monster 73. You know, percentage basis, those are just huge moves. And right below that, you can see the VIX is up 242. We did a study the other day talking about when the S&Ps move about 1%, the VIX has a tendency to move about 4%. And what you're seeing today is the S&P is moving about 3%, 120 points, it's just about 3%. And the VIX is I guess we're talking right here about up 8%. So it's trailing a little bit, but it was kind of lagging a little bit yesterday. But just, some really wild moves as far as implied volatility. Also tonight is, this is we call triple witching, or quadruple witching actually, for June, which is tomorrow morning. And so between tonight and tomorrow morning, it's kind of a time when the reason they call it a triple or quadruple witching is because it's when all the index options, futures themselves, and index options, listed index options, expire at the same time, and they all settle to cash. So for index arbitrageurs with large positions on, they have an opportunity to close out their positions by just letting everything expire to cash. So there's no harm, no foul, no give up to theoretical. Everything settles at the exact closing price. So it's a way to free up a ton of cash. And if the arbitrageurs are long a lot of stock, then there'll be sell programs on the close. If the arbitrageurs are short stock, there'll be buy programs on the close. One of the things that we've discussed at length is the potential for this to be a little bit of an ugly expiration cycle, because as interest rates, depending on what interest rates do, as interest rates go higher, the people that are holding short stock are reluctantly are actually going to hold on to that short stock because you get paid more money. People that are long stock, if interest rates go higher, they have to sell it out because it's going to cost them more money to carry it. So it'll be an interesting tug of war to see what happens, but there's a crazy amount of notional expiration follies going on, especially in this June expiration. So I don't know if the fireworks are anywhere close to being over at this point. I felt like with the hour I have today, and the opportunity I have, and I'm assuming that there's definitely some new people on here, and there's definitely people that haven't seen the tastyworks platform, and there's people that haven't heard us talk. I thought I would cover some of the things, and I changed this up at the last minute because I wanted to cover things that are practical and applicable for the current market that we're in. And when I look at the market today, I'm thinking, okay, what is the most applicable thing I can talk about for 45 or 55 minutes? And I think it would be, I narrowed it down to two choices. One would be, how do I adjust or defend, or how do I give myself some protection in a market move like this? And the other thing would be, how do I take advantage of whatever opportunity is being created by this kind of a move? I mean, on the one hand, we like to, we all love to hear the saying, buy low, sell high, but very few people buy low and sell high. Most people buy high and sell low, which is why we get capitulation at the bottom and why we get capitulation at the top. But I think that when you think about what's happened so far in 2022, and you think about just the huge expanse of bad news that's been out there all over the place, and the market has clearly represented that in dollar terms, we're at 3,600, and we're under 3,700 right now. We're in the 3,600 handle, and that means there's a lot of stocks, a lot of stocks trading at 52-week lows. Not even 2022 lows, but trading at 52-week lows. There's a lot of stocks trading at that are 65, 75, and 85% off their highs, which doesn't mean anything other than they're not at highs. And then, of course, there's people that have long bias portfolios that are a little nervous about, hey, what do I do here? I'm long a bunch of stuff, and I don't feel that good about myself. So, or I don't feel that good about my positions. So I think that, again, the best thing we can do today is to have a discussion on both those topics, and I'll try to break it down the middle. And I think, hopefully you guys find that really interesting. Again, my name is Tom Sosnoff. I'm the CEO of tastytrade, and we own a brokerage firm called tastyworks. This is our platform in front of you. You guys, some of you may have known us from tastytrade, the network. Some of you may be customers of tastyworks, the brokerage firm. Others may have known us from past. We built another firm called thinkorswim in 1999-2000, which we ran for 10 years and then sold it to TD Ameritrade because we were a public company. Tasty is owned by IG Group, which is which is an UK-based brokerage firm. And so we're really global right now. It's great. And I've been doing this for, well, now this is going on in my fourth decade. So I've been around the block, been to a few rodeos, everything they say. And I still love doing it. So, and the last piece is we have a bunch of people on from Tasty and from our trade desk. And so if anybody has any questions, nothing's off limits. Fire anything you want to the team that's on here. They'll answer anything. And we don't sell anything. So we're here for goodwill. We believe that if we give people if we give people some know-how, if we let people know what we know, and whether that's good or bad, I can't answer that question. But if we help to engage and we help to inform and we help to bring some things out that maybe you hadn't thought of before, then we've served a really important purpose to the growth of a financial service ecosystem that we play a big role in. So that's why we're here. We'd obviously love you to come and check out our technology at some point and check out our platform and just look and see what we've built, because we think we build the best financial technology in the world. But that's for you to decide. And all we can do is tell you that as a brokerage, we feel that our journey and our obligation is to be the facilitator of opportunity. That means whatever you want to do, we're here to afford you the technology to be able to do that. So we offer stock options, futures options, and crypto on the platform. We are the only company in America that does that, offers everything. And we are indifferent to strategy, meaning you can do any strategy you want with any of the products that's allowable by the regulators. And you can do it in any type of account. So whether it's an IRA account or a regular margin account, doesn't matter to us. So we don't have any of the restrictions, limitations that other firms have. We don't have any of the product limitations. We are, again, we think the ultimate facilitator of opportunity, and that's why we're here. And we also, I think, do an amazing job supporting our customers all over the world. So without further ado, let's talk about things that would be interesting to individual investors. So now there's a couple of ways we can look at this. In Tasty, we have lots of watch lists, and we can look at watch lists. For example, we have stocks near 52-week highs. We have stocks near 52-week lows. One of the things we can start off with is just click on, hey, stocks near 52-week lows, and just take a look if we wanted to. And we can sort by symbol in alphabetical order if you wanted to. And you can see there's some big name stocks up here that you might have, not realized. I mean, this is AAL, is American Airlines, and I'm not using, there's no particular order, so nothing's set up in here. Apple, right near a 52-week low. And Airbnb, just looking down at some of these stocks and not even getting that far, from Adobe, which has earnings this afternoon, another stock. And you can go right down the line, and it's actually scary how many, this is just stocks near 52 weeks lows that we consider to be reasonably liquid. I mean, when you're looking for a reason to potentially think we're entering a period of capitulation, I'm only at the L's right here. And these are stocks near a 52-week low. And we have, I'm just guessing, but that I probably just scrolled through at least 400 or 500 stocks in this list. Now I'm going to show you something really funny, because it's taking me, to get back to the A's, it's taking me a while. I'm going to go back up here to the top, and all these watch lists are built in as defaults into Tasty. And I'm going to go to stocks near 52-week highs. This is the entire list. So sometimes we look for things like, hey, you know what? Show me a little, tell me why you think we are possibly capitulating. Well, here's my entire list of stocks near 52-week highs, and it's maybe 20 stocks. Stocks near 52-week lows, I don't know, 500. So there's definitely an imbalance. It's not like we have a lot of stocks near highs and a lot of stocks near lows. We have virtually no stocks near highs, and we have almost everything near lows. So that's interesting just to start with, okay? And one of the things that I like to do, and one of the cool things about Tasty, and I'll just go back to, let let me just put this on Tom's default so you can see this for a second. This is kind of how I generally set my screen up with, this is my own watch list here, which I use futures to start with, and then I go into stocks and things that I trade. I do it based on futures first and then liquid stocks. But also on Tasty, we have an embedded watch list built into the middle. Now, some of the cool things about this platform is, unlike other platforms where you have to switch pages and switch lots of columns and everything, Tasty never moves. This is the same layout, the same platform, no matter what you're doing. Everything just switches around in the middle column or the right-hand gutter or the watch list in the left-hand gutter. That's it. So nothing ever gets out of place. It's super clean and easy to use. So I'm going to go back up to this watch list up here, and I'm going to go, instead of 52-week high, I'm going to look for something that that may fit what I, the way I like to look at things a little bit better. So I'm going to go down here and I'm going to look at liquidity because I like liquid options. And I'm going to go to high option volume because I like trading options and I like things that have lots of option volume. Now, I'm also then going to sort, because on Tasty, we allow you to sort through anything. So we kind of have all these watch lists with built-in sorting tools. I'm going to sort by IVR, which is implied volatility rank. And as you can see here, I can do it from high to low, which I like. And I can see what stocks have the highest implied volatility rank. Implied volatility rank is a measure of implied volatility over 52 weeks against itself in each underlying. So if I wanted to look at a stock, for example, like Tesla, and say, hey, how does the implied volatility of Tesla right now rank against itself? And the answer is very high. Obviously, you can see right here, it's 92%, which is, on a scale of 1 to 100, that's obviously the high end of the range. So I'm looking here, and Adobe has earnings, like I said. I'm looking at this list to find something that may be an inexpensive price stock with high implied volatility, so we can get to the point of having a discussion about, hey, this might be something, if you're interested in something like this, this may be a stock that's very affordable and that there's different things to do. And I'm just going to scroll through this list because all the implied volatilities are so high. And I don't have a specific underlying that I'm looking for, anything like that. I'm just looking for something that, hey, maybe this stock has had a huge move, or maybe this, maybe this is some stock you've heard of. So I think for argument's sake, just to keep things liquid and clean and just have an interesting discussion, I'm going to go to ARKK with this, which is Kathy Wood's fund, which is a high beta fund made up of a lot of stocks, including Tesla and things like that, that have had huge moves. That is very much, you can see this is a quick wrap up here, but I'll put up a chart of this stock just so you can see it. I'm not a technician, so I don't use charts, but you can see, just to give you an example of what's happened to this stock, ARKK, it was hanging out in the 100 area for a long time. Now it's down in the 37 area. It's a fund. And this is, for the most part, it's from where we consider its highs, let's call it about 130-ish in that range. This is just over the last year. We call it 130 down to 35. You're pretty much talking about a 75% decline from high to low. And as you can see right here, it is sitting basically on its low. And so that becomes interesting to me because the IB rank is almost 81. The price down big today, as the rest of the market is, and the stock is sitting right on its low. So, okay, so this is a fund, so it's not an individual stock, so it's got some diversification in there. And let's take a look. If we go to trade, we're going to take a look at the implied volatility here, which I like. In July, it's 82%. In August, it's 77%. This is a classic backwardation, but it's fine. It doesn't mean anything. It just means there's more near-term risk than there is long-term risk, and or the market perceives there to be more near-term risk. And we can pick, any month. And in this case, I'll use July. There's 29 days to go to expiration. Does this meet our volume criteria of being liquid? And the answer is, of course, it does. It's traded 16 million shares today. Does this meet our implied volatility rank criteria of being high? Yes, it does. It's 81 out of 100. Does this meet our tight market criteria? Yes, it's 1 penny wide. Okay, so it's liquid based on volume. It's liquid based on the tightness of the market. It's has the high implied volatility rank. It's got good great implied volatility on its own. The difference between implied volatility rank is implied volatility measured against itself. Although it seems like it's similar to the actual implied volatility, which is 82%, they have nothing to do with each other. And the expected move over the course of the next month is $6 based on the current level of implied volatility. Why is that important? You see where it says 5.98 there? That means the expected move for the next month is $6. I'm just rounding up. The reason $6 is important is because that gives you context over where to set up your orders. So I'm going to open up July options. And this is a whole screen. We don't need all of these. We can probably reduce it to, let's say, 16. Perfect. So, and the reason I reduced it to 16 is because that gives us about 6 points wide from the current price. This line is the at the money strike. And 6 points would be the expected move. So I feel good that you can see everything you need to see on this screen right here. Now, a couple of things. We use different columns here. I'm using delta. That is the theoretical stock equivalent per share stock equivalent for each one of these options. And then I'm going to use volume because I want to make sure things are trading. And yes, there's hundreds, thousands of contracts trading. But if I was to look at, for example, the 40 calls, the delta is 40. That means that the 40 calls have a share equivalent of 40 shares of stock. If I was to look at the 42 calls, they have a share equivalent of 31 shares of stock. That's how much you'd be buying or selling if you sold that naked option, or if you bought that naked option, or if you did a spread, it'd be the difference between the two, all of the above. Well, one of the neat things about, Tasty is there's lots of different ways to skin the cat, as we say. And this is a stock that, although I'm not bullish on the market, although I'm not necessarily bullish on ARK investments or ARK Trust, I do think this is an oversold, high beta underlying that if the market does turn around, this one will have good performance. So let's talk about the different ways to play it with what I feel like is limited risk. This expected move of $6 is represented by this implied volatility, which takes into account this current level of, the S&Ps and everything that's happening in the world. That's called efficient market theory. So the market, everything the market knows is built into these prices. If the expected move is $6 and the stock's currently trading at 37, that takes us down to the 31 strike, which means there is a very low chance. In fact, the chances of, if we sell the 31 calls, you can see right here, there's only about a 20% chance that we get under that level. And if you talk about your break even, sell the 31 puts, So the 31 puts, your break even is going to be 30 because you're collecting over $1. And in that case, the chance of getting down there is 16 or 17%. So the first thing I would do in a case like this is let's keep our size small, just for this example here. We'll do a 2-lot, and the market is 110, 115, which means theoretical value is probably 112.5. But because they're popping up implied volatility today, and we'll see what happens here, I'll put my order in at 112, filled. So the beauty of Tasty is that we are the only high-frequency trading platform in the retail space. That means we use HFT internal technology as our middleware. No other platform in the world has that for retail customers. That's why this platform is so fast. And I just sold those. You can see right here, this is my activity. I just sold those puts at 112. Now, I might say, hey, you know what? That was pretty good, but let me see how good that fill really was. So I'm going to try to offer 1 lot at 113 just to see if I get filled. There's my 1 lot offer. I did not get filled. So I know that 112 fill was probably pretty good because I can't get filled at 113. So I right click on this, and remember, everything's right in front of you. It's the same damn page. So you're not even switching page. You're not getting confused or anything. And I'm just going to go cancel order. There, my order's gone. And that's the beauty of Tasty. It's just lightning fast and everything's right in front of you. So I just sold a 2-lot of the 31 puts in ARK. How many shares of stock is that the share equivalent of? And you can see over here, the 31 puts have 19 delta. So the share equivalent there, is 19 shares. And since I did 2 of them, I just bought, let's just round up and say I just bought 40 shares of stock. Now, it's significantly cheaper to sell 2 puts than it is to buy 40 shares of stock because the capital requirement's less, so it's a more capital efficient trade. And if I bought 40 shares of stock, my risk reward, my probability of profit would be 50-50. But by selling 2 puts, I limited the amount of money I can make, but my probability of profit is 84%. Now, another nice thing about Tasty is if you go to sell these puts, we will show you, we'll figure out probability of profit a little bit different, but you can see right down here, we'll show the probability of profit at 80%. And we'll show the probability of making 50% of max profit at 85%. That's cool because nobody else shows those 2 things. So we have a bunch of Monte Carlo simulations built into this line here, which show you everything from your probability of profit to your extrinsic, to your probably making 50% of max profit, to the delta on the trade, to the beta weighted delta. So what does that mean? That means that I just sold a 2 lot, and that's the equivalent of 40 shares of stock. But if I was to weight those in SPY shares, in SPY shares, it's only 6 shares of SPYs, the theoretical equivalent, which is very accurate. My max profit in this trade is a little over $220. It's actually because I sold them 112, so it's 224. And my max loss is theoretically unlimited, or the stock go to 0. And then my buying power reduction. That's it. Now, that's one way of getting long. Clear this trade. I'm still a little bullish on ARC. Let's just say, instead of selling puts, which have a limited profitability of, each put had a limited profitability of $112, I'm going to go out and I'm going to buy stock. So I'm going to click on the offer. I'm going to buy stock. I'm going to reduce my size here. Oops. Hold on one second. I just have a bunch of things blocking this. I'm going to reduce my size here to 100 shares. Okay. I'm going to then choose an underlying option to sell. I'm going to do a covered call. So how do we usually do covered calls? Well, generally we sell the 35 delta, the 36 delta in this case, which is the 41 calls. So I'm going to click on the bid of the 41 calls. Now this platform is indifferent to strategy selection. You can do whatever you want. So I'm going to buy 100 shares of stock. I'm going to sell
Hey, Tom, can you show your screen?
Oh, did I lose that?
Yeah, you lost it.
Hold on, Britt.
Should scroll down to the bottom where it says screen share on the Zoom platform.
Where it says screen share. No, it's not popping up for some reason. Let me see. That's weird.
It might be on the top versus the bottom once you're presenting. Do you see the green arrow?
I don't see it. Do you see it? You can tell me where it is. I don't see it.
So like if you see there's like a mute button, it'll be, you might have to like wave your mouse over the top or the bottom of your screen to see share screen.
I don't see it. It's weird.
I'm asking Garrett to come up and help you.
Yeah, I've never seen it disappear like that. That was weird.
I mean, the interface auto hides also, Tom. So if you don't go down to the very bottom or very top, it might not pop up.
Oh, I think, hold on. I got it. I got it.
You got it?
Yep.
There you go. Okay.
Okay, do you see it?
Yep, it looks good.
Okay, let me just move this over. Sorry about that, guys.
All good.
Okay, perfect. Close this up. Let me make sure I have just enough. I want to get this set up the way I want. Okay, so now getting back to this trade. I'm trying to buy 100 shares of stock. Stock says rally as we're talking. I'm going to sell one of the 41 calls against 100 shares. That's a covered call. But what I wanted to get into was a little bit of the difference between a covered call and a naked short put. On a risk graph, and from an analytical side, they're virtually, the graph looks the same. The difference on the put is the most I could make on this put was $1.12 because that's what I sold them for. So I can make $112. On the covered call, I can buy the stock and sell the 35 delta call. And just think about this for a second. If the delta on the put was 20 and the delta on the call side is the 100 shares minus 35, so it's going to be the equivalent of being long 65 shares. It says 64 right here because it's actually the delta just changed on the put on the calls. But so this is long. So 100 shares and buying 100 shares and selling one call against it is the equivalent of doing 3 naked short puts. So buying 100 shares and selling one call, you should have an opportunity to make more money. So the difference between a covered call and a naked short put is you have the opportunity to make more money on the covered call. Now, again, remember, we're showing right now strategies. We are showing you strategies for a market that is oversold. What are the perfect conditions for covered call buying? Low basis, that's low stock price, and high implied volatility. You could argue that a stock like ARK that has dropped from its highs, it's dropped 75%, that's low basis. And you could argue that when the volatility is at 81%, the IBR, that we are sitting right at the high end of its volatility range for the last 52 weeks. It meets all the criteria. So now the platform will then figure out for you, buying 100 shares of stock and selling this call will net out to $35.50. Okay, and then what can you make on this trade? Well, you can see right here, the max profit on this trade is $545, and it's all built into this. But the difference is that it has a lower pop. You can make more money. It uses more capital, and it has a lower probability of profit, but you can make more money. But I'm going to show you this, and the mid price. Usually we go up about 2 cents on mid price, just on covered calls. It may take another penny or so. And then I'm going to route this order. So you can see this order sitting right here. Now, the cool thing about tastyworks is you can watch the market over here, and the stock just rallied. That's why I didn't get filled. The stock just rallied like 15 cents. The stock, you can see the whole market over here. Oh, there you go. Amazing. You can see the whole market over here. You can see a chart of whatever you're trading over here if you want to. You can see all the quote details about this stock, like 52-week high. This is the liquidity meter here. We rank every stock by liquidity. You can see a dividend if it has one. You can see high, low. You can see earnings dates, everything in there. You can see all your positions in this stock. These are my positions in this stock already. So this is the 100 shares I just bought. This is the 2 lot of puts I just sold. Here's the 1 lot of calls I just sold. And then this 20 lot, this 15 lot, and this 20 lot are existing positions that I already had on in here. And so what I'm showing you how simple this is. If you want to see all the activity we've done in ARK today, you can just look at filled here, and these are the 2 trades we just made. Okay, so it's super simple to see everything on one page. And again, we have a lot more functionality than even that, but that's just to give just the simple view. Now, that's getting long a stock that has high implied volatility, lots of liquidity, and that has low basis, as we say, that's kind of on its butt. What about if you have an existing position on? What about if you have an existing position on in some underlying and it's simply, not doing very well? Or you have an existing position on in an index product and it's not doing very well, okay? That's the second piece of what I wanted to talk about today. The first piece is kind of easy. It's easy. It's harder psychologically to buy into a dip than most people realize because you're nervous. And, everybody's nervous about buying when things get cheap because you're wondering, oh my God, am I buying into a crash? Am I buying into this or that, whatever? Those are tough decisions. Those are tough things to do. It's very difficult. Like what I just did looks super simple, but it's hard to do. It's hard to pull the trigger because A, you're wondering if you're getting ripped off. B, you're wondering if you're doing it at the fair price. You just have no idea. So I think it's super important to make a lot of small trades, trade small, trade often, because that's a way of training your brain to make decisions and to accept risk when you should be taking risk. if you want to use a platform that facilitates opportunity, you have to take advantage of it. And that's what something like this is. Okay, but the next thing I want to cover is what happens if you have a position on and that position is like, it's ugly. You know, whatever's happening, it's not working. So I'm going to pick an underlying that I have a position on that's not working. Okay, let me just, I have a lot of those, so it's not going to be very hard to find. But I'm going to do FXI, which are Chinese stocks trading in Hong Kong. Large cap Chinese stocks trading in Hong Kong. IB rank is 56. That's high for FXI, which is, again, Chinese stocks trading in Hong Kong. Volume, 24 million. Obviously, a huge number. The bid-ask differential, 1 penny. 80, 81, 79, 80, whatever it is, it's 1 penny wide. Stock's down 112 today. Looking at this particular stock, it's not at its lows, but it's not pretty. I mean, this is like all other Chinese stocks. It's had an ugly year. It's gone from 40. This level up here is actually 44, but it's gone, this level here is about 42, and it's down to, 31 and change. So although it hasn't made another low, it's ugly. I am short a strangle in here. This is an actual position. I'm short the 34 puts and the 32 calls. That's a long position. The puts I'm short are 280 and the calls are $1.40. So I'm net long a lot of deltas. Let's take a look and see actually how that works out. So I'm going to go over to here. I'm going to open up July options. This is just I'm going to back into this to show you how to do it. The 32 calls, they have a delta of 50. They're just out of the money. The 34 puts, which are these puts right here, they have a delta of 70. So that means I'm long 20 shares of stock for every one of these spreads. Okay, because I'm short the 70 delta, I'm short the 70 delta put, I'm short the 50 delta call. The net difference is -20. So -20, I'm sorry, in this case, +20 deltas, because puts are positive, and then times 80 contracts, I'm long the equivalent of 1,600 shares of stock. And the stock's down, $1.13 today. So this is not a good position. It's down $1.13 on 1,600 shares, which means I'm probably down just around, with the pop in volatility, maybe let's say $2,000 in this particular stock today. So how would, if I wanted to adjust this position, or if I wanted to do something to defend this position, which is long the equivalent of 1,600 shares of stock, how would I do that? What would be some of the defense mechanisms that a new trader or an experienced trader or somebody that's not used to seeing this kind of decline, that's long a lot of stock, might say, hey, what can I do? Let's just say I said, you know what? I'm really comfortable being long 1,000 shares of stock, but 1,600 shares has gotten a little ahead of it. So I would like to hedge a few hundred shares of the stock. Well, the easiest thing I can do, obviously, is just, if I wanted to get from 1,600 to 1,000 shares of stock, I could just short 600 shares of stock, right? So if I click on the bid and adjust my quantity, let me just move this down here so I can see. And I adjust my quantity to 600 shares and I routed it, that would make me flat. So what I'm going to do here is I'm going to show you a bunch of different things. So I am not interested in selling 600 shares. So I'm going to raise the price and then I'm going to route the order. So just so you can see all the different trades up here. So there's the 600 shares. That's one choice that I have. Okay, let's think about what else could we do. So if we wanted to create some short delta that was the equivalent of 600 shares, what are some of the other things I could do? Well, for starters, I could easily sell some calls. So if I want to do the equivalent of 600 shares of stock, the delta of these 34 calls is 30. So I click on the bid, okay, and all I need to do is sell 20 of these. And again, Tasty lets you do all this. I'm going to raise the price because I actually don't want to sell 20 of these. I'm just showing you guys how to do it. And I'm going to sell 20 calls above the market. There's the 20 calls. Now we're going to say, hey, you know what? I mean, that's okay, but I don't want to sell. I have a short strangle here. I don't want to add more short calls to this. So what's another way of getting short 600 shares of stock? And so what I'm going to do here is I'm going to buy the 33 puts and I'm going to sell the 30 puts. The difference between these two is 30 deltas. So I need to do this spread 20 times. 20 times 30 is 600. And I'm going to try to buy this spread. It's actually trading for let's call it 140. I'm going to put a bid in around $1 just so I don't get filled. I'm purposely trying not to get filled to show you all these things. And then that's that spread. Now, what else could I do? I could go out of the money and sell an out of the money call spread. So I could go up and sell just as an example, I could sell the 33 calls and I could buy let's call it the 36 calls. That's a delta of 20, a little over 20. So I could do this spread 25 times. And I would have to sell this spread. And so I'm going to raise the price on this. Now, as you can see in this column here are 4 trades that I've entered. All of these trades that have the sole purpose of taking off about 60%, about 40% of the risk I have in this trade. Now, you can do this for any single underlying and any single trade. But I picked FXI because I have a naked strangle in there that's going against me that has the equivalent of 1,600 shares of long stock. So obviously I can sell 600 shares of stock and take my risk down by 40%. Or I can sell a 20 lot of naked calls. But the stock is expensive, the naked calls are expensive. I could then go out and I can buy a put spread, which is relatively cheap to do, and buy 20 put spreads with 30 deltas in the put spread, or I can go out in FXI and sell 25 call spreads. All of those trades reduce my risk by 40%. But 3 of these 4 trades also do something else. They add short premium to my position, and so I'm collecting decay if the volatility. So none of these positions I actually paid money for. So I'm collecting credits on all these positions. So hopefully, I'm hoping that volatility contracts in addition to the delta adjustment. So why would somebody do this? Well, because when volatility is real high like this, I purposely didn't go out and buy any puts. And I probably would never buy stock here because we call this static. We call this a static adjustment, and we call these dynamic adjustments. And in a perfect world, I want to make dynamic adjustments, not static adjustments. Okay, now a lot will depend on how much capital you have and things like that, but it's one of the beauties of a platform that is indifferent to what you use, what you do strategically. Like that's the beauty of everything we do at Tasty. We are indifferent to however you want to use your brain to come up with whatever strategy you want. We don't care. Like we're never going to tell somebody you can or can't do certain thing because unless you don't have the capital to do it, but because we want you to challenge yourself to use the strategy that fits what you want to happen the best. Now, so I don't forget that I have these here. We just hit cancel order, cancel order, cancel order, and cancel order. Now I'm back to what I originally started with, which I'm not making any adjustments in here, but just so you can see this, and we keep that, in the keep the original position on. But I want to take you through that exercise of being able to see everything. Now, I think it's also important that people that are on this for the first time recognize that some of the things that we do on Tasty are a little different than other firms have. Like, for example, one of the things that we offer are digital assets. And if you've been following what's happening in cryptocurrencies and digital assets, they've been getting killed as of late. And so Bitcoin is down to, it's down to, here you'll see right here, 21,000 basically. And this is Cardano, this is Solana. Most people trade Ether. It's just over $1,000. I mean, this was traded as high as 4,400. This traded as high as 66,000. This is down, almost 68%. This is down, 75%. So, and those are the two biggest cryptos. They account for 75 or 80% of all the trade that goes on in digital assets. But we trade other things like, Solana, Cardano, things like that. And all you can really do is nibble on it. But the cool thing is, on the Tasty platform, you can buy all these or trade all these in the same exact account using the same methodology as anything else. So if I said, you know what, right now I just want to go out and buy a little, let's just say I want to buy $100 worth of Ether, okay, which is Ethereum, just for the hell of it. Let me just move this thing. I just hit review and send and double click, and there's my fill in Ether. So we route to multiple exchanges, liquidity providers, market makers, and even crypto exchanges in the back end of this platform. But let's say, forget about crypto for a second. Let's say I want to look at something that's been absolutely crushed. / I'm going to go to 6J, which is the Japanese yen. Now, this is something, give me 1 second. The Japanese yen is actually up today. It's having a good day for a change. But I'm going to show you something that's ugly. This is ugly. This is the Japanese yen, which has been in a incredible free fall for basically a year. It hasn't really had an uptick. And we've been leaning a little bit long on the Japanese yen. These contracts are quite big. But the reason I wanted to show you this is that Tasty, you can trade ARK, you can trade Tesla, you can trade Ethereum, and then you can go right over and trade some cryptocurrency. I'm sorry, some currency, some FX currency, and you're doing these on an exchange. This is not an over-the-counter marketplace. This is at the CME, and this is the Japanese yen. If I wanted to go, for example, to the British pound /6B, this is the British pound. I mean, they've had some nice little up moves today, but these things have recently been killed. If you want something that's super more liquid, let's call it 6E, which is the euro. They've had actually a little rally of the euro today. But when you start to look at what's happening, globally, you might say, hey, you know what? I really like the risk reward, or I like the opportunity potentially in trading one of these products as much as I like trading Tesla, for example. So I think that the opportunity to go from Bitcoin or Ether to the British pound or the euro back to Tesla and something else is so damn valuable. And yet virtually no firm in the world allows you to do that. And it drives me crazy. And we don't care what strategy you use. So if you wanted to go to the euro, for example, and I don't think I have a euro position on right now. Hold on, I don't. So if I wanted to go to the euro and I wanted to go out closest to 45 days, and here, IV rank is high, volume is huge, 225,000 contracts, which is a lot in the futures world. And I want to go out to August expiration, and this is a fairly liquid contract, and I want to use all the exact same methodology that I just used for selling the puts in ARK investment. I'm going to open up 20 strikes here. I'm going to go to the 20 delta if I wanted to, and the market's 40.42. These are futures options. And again, it's the exact same layout. So I'm going to go to a slightly higher option here. I'm going to go to, I like to collect a little bit bigger credit. So I'm going to go to the 104 strike. And at the 104 strike, I'm going to raise my price to 77, which is right in between the markets. And I'm going to enter it. I'm not filled yet. And there's my working order. And the reason I'm showing you this is because I believe the value of being able to go from one product to the next product. Oh, filled. There you go. That's an electronic book. So it's not like we can't make a better market at Tasty than somebody else. That's the electronic book at the CME. So you're filled when you're filled, based on when your order came in. But the reason I did this is because I want to show you that I did a trade in ARK that has an 84% probability of profit. Well, I just did a trade in the euro at the CME with the exact same statistical chance of success, 84%. And the amount of money we took in is a little bit different because this is a bigger contract. So just call it about $1,000. That's the difference. So in ARC, it was $112 for one lot. Here, it's about $1,000 for one lot. It's a bigger product. But again, what's important about this is from a single platform, being able to do all of these trades in a, basically, one to the next to the next. And it's just, it just is the most effective way to trade, and specifically to trade a lot of non-correlated underlyings. That's what's so beautiful about it. You don't have to do everything. The euro has very little correlation to the US stock market, has very little correlation to digital assets. And so I think that that's kind of, what's so important. And then you might say, hey, you know what? I was listening yesterday to all this stuff that was going on, with respect to, the Fed raising rates by 75 basis points and all this kind of stuff. I want to see how that impacts, short-term paper. Well, we're the only firms that supports the small exchange 2-year, which is this product right here. There's no options on it yet, but you can see this is the 2-year. This is the 2-year note, and this is the actual interest rate on it, 3.2%. It's down 21 basis points today. Some people might prefer to trade, like for example, the 10-year, the 30-year. I tend to like the 30-year, and here's the 30-year right here. So, it's trading at 33.78. It's up 35 cents. The little bit of a widening of the knob spread today, as we would say. But we offer all this stuff. So if you wanted to trade, this is on the small exchange, but if you wanted to trade 10-year notes on the Board of Trade in Chicago, which is the most actively traded contract, that's what this contract is. 10-year notes right now are up 21 ticks. Bonds must have had a huge turnaround today, I guess. Let's take a look. Yeah, bonds up 30. There you go. So these are bonds, and here are bond options. And if I wanted to sell a put in bond options, I would just go down here and boom, same thing, sell the 20 delta put. Here you go. Same as in the euro, same as in ARC, same as in Tesla, same as in Bitcoin if you wanted to. Again, all through the same platform, all the same methodology, and that's what we do here at Tasty. So just as a little bit of a recap to get you kind of to an important point, I covered 2 topics today, primarily because we're in a certain type of market where I'm not going to say that we're capitulating. I'm not going to say we're grossly oversold, but we're closer to oversold than we are to overbought. That's for sure. And we're also in a market that's had a huge sell-off year to date. We're also a triple witching. And I think in order to remove some of the nervousness and to make people feel a little bit better about what they're doing, about their positions, about their confidence levels, I think that what we did today was interesting. We showed you how to put on a new position. I used ARK, ARKK, and all I did was sell 2 naked puts and do 100 shares and sell 1 call of a covered call, and showed you the difference between the delta on those and the amount of money you can make, and the amount of money that you use to do it. Then we went over and looked at a long delta position that was losing money for me in FXI, which is the Chinese, Chinese large cap stocks trading in Hong Kong. It's a very liquid index. I was long 1,600 shares of stock. I showed you how the equivalent of how to hedge 600 shares of stock by either A, selling 600 deltas, or which is the equivalent of selling 600 shares of stock, or selling an out of the money call for 600 shares of stock, or selling an out of the money call spread for 600 shares of stock, or buying a in the money put spread, which actually has positive decay working your way. All those trades. Then I just briefly showed you how to make a digital asset trade by buying a little bit of Ether. And that is kind of the, the guts of today's discussion. I also wanted to take you quickly through the tastyworks platform, but do it without doing a software demo, but do it so show you kind of what we offer, which is showing you some of the Greeks down here on potentially on different trades, showing you how the watch lists are fully integrated into the platform, how everything on the platform is built into the right-hand gut of the platform or into the center of the platform. And if you said, hey, you know what, this is really interesting, I would like to learn more and stuff, you can actually watch every single trade I make on a daily basis. Right here, we have what we call a follow page, and you can watch all the different trades we make. And we've had that since inception. We have actually lots of different features, multiple charting platforms. You can watch our network here streaming, different watch lists. And then the last feature I want to show you, which is very cool, is a feature that we have, and I'll go back to ARK, ARKK for a second. And we have a feature on this side of the platform that actually shows you, we call it chains. And this feature over here will show you every single trade that you've made or adjusted in the trades that you currently have on. So if you're ever wondering, hey, I put this trade on about a month ago, I want to see how I've done. I've made a couple of adjustments to it. We track everything for you from inception. We're the only platform that does that. So we have a bunch of cool features, including analytical features, including, I mean, obviously everything else, watch list analysis, alerts, multiple trade layouts, pairs trading. We even have, for people that are very visual, we have a curve mode. So for example, if you wanted to see something, like if you wanted to, I'll do this in like 2 seconds. If I wanted to set up something like, and I'll just use something like an iron condor here, I'll do it real simply. If I wanted to do an iron condor at ARK like this, but I want to see it in a different mode, because you're a visual person, here you can see it in a visual layout. And here is a picture of an iron condor in ARK, and you can adjust the strikes by just dragging these little tiles. You can adjust all the strikes if you want to. You can see where it's red, you lose money, where it's green, you make money. This is the distribution curve you're living inside, even though it looks a little asymmetrical. But again, it's amazing technology, super cool. And John, I'm going to turn it back over to you. I've used up my 55 minutes. Man, that was great today. I really enjoyed it. Markets are giving us some stuff to talk about. And, thanks so much for letting me do this again.
Yeah, people can't complain. There's nothing to do in the market today.
No, you cannot.
Answering emails from people telling me what a great presentation you made.
Well, listen, thank you so much. I mean,
So you're hired.
I'm not looking for a job right now, but we'll
You
see.
never know. Always good to have a backup plan.
Never bite the hand that may one day feed you.
Yeah, as they say in the Marine Corps, always have a backup plan.
There you go.
Always have an avenue of retreat. Okay, that was great. I look forward to seeing you again in September, and you have a
Cool.
great summer.
Thanks so much. Thanks, everybody.